Let's dig a little bit more into the media stocks that have been affected by this, namely Viacomcbs and Discovery. Tuna Amobi is joining us now. He's CFRA Senior Research Analyst. Tuna, it's always great to see you. You did cut your rating on Viacomcbs, but just to a buy from a strong buy. So, and as I mentioned at the top, it's already had a 55% pullback as all of this has been going on. Why do you think that the fundamentals are still strong for this company?
Good morning, Julian. Thanks for having me. Indeed, we actually cut it, just before they announced the equity offering when the stock was almost hitting triple digits. So in hindsight, it was actually a good time to pare back from strong buy to buy. But then you kind of have this, what I might call the exogenous event of the margin call, which caught a lot of avid watchers of the stock somewhat flat-footed. So I might add that while these kinds of things cannot be fully anticipated, when you think about it, there is really nothing that we see that has changed from the fundamental story of Viacomcbs, which is why we think that this pare back sharp retreat in the stock, as much as it kind of suggests continued volatility in the near term, we think it's a good time to actually, add to positions, which sounds like a contrarian view. But when we look at the valuation, Julie, the stock right now, even considering all of this, sharp decline, is still right around, an average, rating for the large media group in terms of enterprise value to EBITDA. When you look at PE now, the stock is trading at a fairly significant discount, 15 to 20% versus its peers. So we would take that contrarian view that it's a good time to consolidate your position, since nothing has fundamentally changed on the heels of the recent launch of the streaming offering, Paramount Plus, which we expect to gain significant traction.
Tuna, why do you think hedge funds have piled into these old media stocks like a Viacom, like a Discovery? And are you seeing any other crowded trades in media within your analyst coverage?
Yeah, I mean, there's no doubt, Brian, that this issue has had some type of domino effect. And remember, Viacom, I think you can look at the media world as either content players or companies that are on the distribution side, or some companies somewhere in the middle. When you look at the pure distributors, it doesn't seem like they've been as caught up within this as more of the pure content companies like Viacom, the Discovery. This is obviously a different animal because they've got other portfolio of businesses which are totally unrelated, theme parks, etc. So I think to your question, Brian, there seems to be some correlation in these trades here. When you look at the short interest of some of these content names, including Viacom and CBS, they seem to be, they have been fairly on the above average side. So what this has done is to kind of heighten some of these, trades and bets. And I think I would talk about leverage and the tendency to use that leverage to magnify some of these bets. So our sense, Brian, is that this volatility is something that's going to persist in the near term. But ultimately, as I indicated earlier, there's really nothing fundamentally that has changed that makes us believe that, there's any major issues that will restrain the long-term outlook.
Tuna, one of the interesting dynamics about the run-up that we were seeing in these stocks is that they were happening at the same time the reopening trade was popular. And one would think that if reopening is popular, if people are going to be going out and doing stuff, they're going to be spending less time in front of their screens watching streaming services. Do you think that is going to be a threat this year? Even as you say, yes, Viacom's a little bit diversified in terms of theme parks, but still most of its revenue comes from cable networks and people watching stuff.
Yeah, that's a fair point. But, remember, a lot of these names are very, very cyclical in nature. You get advertising being a major component for a company like Viacom. But also you have distribution affiliate revenues, which seem to be longer term in nature and have been locked in for years. So somewhat immune to, the reopening phenomenon. So what has happened is that each company has tended to, be impacted by that reopening expectations somewhat differently. I would think companies like Disney, for example, have been at the top of that pyramid in terms of the potential impact. So when you think about other companies, for example, that provide broadband streaming, the pie providers like cable, you could argue that the stay-at-home theme has somewhat dissipated for some of these names, which is why you see names, the cable companies kind of trading sideways. But I would say that the reopening trade is still alive and well, frankly, when you think about the prospect of vaccines and where the shares are trading now compared to historical averages. We still think that it's not too late to really jump on that bandwagon, especially for those companies that have portfolios that will be leveraged to the economic reopening, coming off of significant cost cuts, which should provide additional operating leverage once the revenue starts to come back.
Tuna Amobi, always good to get your perspective on these media companies. CFRA Senior Research Analyst will be continuing to watch Discovery, Viacom, and that streaming trajectory as we head throughout the year.